Good morning, everybody, and welcome and thank you for joining us on Q&A with Whitey. I'm coming to you this morning from FBAA Central. Yes, I'm in the office today. Quite an unusual experience after working from home for so long, and we still continue to do that. Anyhow, here in the office today, and looking forward to our conversation this morning. And I do say this morning, for those of you in other states that want to try and hijack the timeline, well, hey, Queensland is the right timeline. This is where it's at. So it's still morning here, so it's still good morning. I trust you've got your coffee ready to go. Got mine already on the brew. And of course, some morning tea. So whilst we chat, you can sit there and have something to eat. Now, I'm very fortunate. My wife has given me some fruit and a homemade muesli bar and a homemade blueberry muffin for me to eat this morning, which I think all that will probably be lunch more so than anything else. But anyhow, hope you're ready for today's conversation. And before we jump into that, I'd better say thank you to those people that look after us and are able to do what we can do and to bring you all our content free of charge. I'd like to thank ALI, Bluestone, Suncorp, Finstro, OnDeck, Prosper, Speedy, Len, AAMC, Strive Financial, Insurance Advisor Net, Credit Fix Solutions, and Trailbook Loans. Thank you to all those folks who join with us in partnership with what we do and bring to you from the industry. Anyhow, let's get on with today's conversation. I'm very, very excited to introduce this gentleman to you. And for the sake of transparency and clarity, this man and I go back a long way. We know each other well, but it's why we can have this conversation we're about to have. So I welcome Mr. Kym Dalton, who's the Managing Director of Australian Mortgage Marketplace. Kym, welcome, and please come online and join us in our conversations. There's the great man. How are you, sir?
I'm extremely well, and all the better for your inquiry, Pete. It is afternoon here in Sydney. I hasten to add.
Yes, I understand. Yes, you're manipulating the timeline down there, so that's all right. You guys do the way you want to do it. That's all right. Daltz, thank you for joining us this morning. And just for those that you don't know, and I did mention in my intro, Kym and I go way back. But I will say, and you can call me biased, Kym is probably one of, if not the most intelligent men in our industry, and it's why I quite often refer to him as a futurist, because he can, the level of knowledge, Daltz, that you've got is visionary, because you can see beyond just what's happening now and the impact that takes in a journey. And that is so critically important about what we're going to talk about this morning, because we can get very much caught up in the emotion of things. We've got to try and see past some of that to be able to understand a balance of realities, and it is a balance, but also where the journey can go if we take it on the wrong trajectory. So we'll chat about all that as we go. But what I'd love to do first is for everybody to get the opportunity to know Mr. Dalton a little bit better. So Dalton, tell me a little bit about your background. You obviously haven't been always with AMM. Tell us about your past history, where you've come from, a little bit about you as a person, and then we'll jump onto some fun stuff.
Could be an interesting tale. I'm quite often asked, how did you get into finance in the first place? Well, here's the story. I started off in the rock and roll business, actually, and working for a independent record label in Melbourne, and I had a Holden Tirana, doing rather well. I managed to fail second year arts at Monash, got a job in the rock and roll industry, and bought a Tirana. So I thought I'd reach self-actualization. And then, as happens with Holden Tiranas, gearbox broke. So I went along to my boss, who's quite high profile, still in the industry, and said, can I have a $20 a week increase to get my gearbox fixed? And he went, no. And I went, well, I can't do my job. So then a rather heated exchange took place. So I quit. So now I'm a failed art student with no job and a broken Tirana. So one of my mates said, would you like to get a job collecting debts for AGC? And I went, not particularly. And they went, it pays $150 a week. I went, I'm in.
I'm in.
So and I thought I'll do this for 6 months and then go back and be the rock god that I so richly deserve. But here we are 40 years later. That's how I got into finance.
Well, there you go. So what else? You've done some interesting things in your past. So did you share a little bit with us about this? Because in one respect with AMM, you've done something sort of similar without the technology twist you're doing in the past, but you've also been in other areas of our industry as well. You want to just share a little bit,
going
with
back
a little
to,
bit of that?
You know, I'm making myself sound rather ancient here, but going back to the late 80s, there was this crazy new racket out of America called securitization, and no one really knew what it was or what it did. And so the AMP lured me away from my cushy insurance job in Perth and said, can you come and run our securitization subsidiary? And I went, sure, but a couple of questions. How much does it pay and what is it? And they went, well, it pays quite a lot and you'll figure it out. So that was 1989. There was a company that mutated into one called Australian Mortgage Securities, which I ran for nearly 14 years, which became the largest RMBS issuer in Australia and New Zealand and was a powerhouse behind Wizard. So I did that till 2002, and then that's why I'm very interested to talk about responsible lending a little later in the show, is that then I entered into the world of responsible lending and formed a company called Credit Ed, which was meant to provide benefits to consumers, brokers and lenders by increasing the levels of financial literacy with an element of compliance. It was a tear-away intellectual success and a financial ruin, frankly. So people weren't really ready.
It happens in life.
It happens in life. You know, we've got some of us have been there. So after I decided that wasn't going to keep me fed for very much longer to be living under a bridge, I decided to head back into what I knew best, which is the world of non-bank lending. Hence, 3 years ago, Australian Mortgage Marketplace, which is a 21st century version of AMS with lots of digital technology, which we think is going to transform the way that mortgages are done in Australia. So here I am.
Excellent. And from memory, AMS got sold to ABN AMRO, didn't it? I think.
No, we were owned partially by me and partially by ABN AMRO, and then Wizard acquired it, and it turned into AFIG, which turned into GE Capital.
Yes, that's right. And
by which time I was sitting under an umbrella drinking blue drinks by the pool.
As you should.
As I should.
So one thing I do want to ask you about, and I hadn't prepped you for this, and I haven't prepped you for any of it really, by the headline.
I'm like a lamb to the slaughter today, Pete.
That's all right, mate. We'll deal with that. One thing that always interests me, with AMM, it's premised on, and correct me if I'm wrong, blockchain technology.
Yeah, I saw that.
Are you able to just give me a layman's understanding of that? Because I still don't quite get it.
Yeah, I'll give you the layperson's view because that's all I know about it. No, seriously, blockchain is associated with cryptocurrencies, which have had various levels of notoriety or fashionability over the past few years. It's actually really called distributed ledger technology. And what we're going to do use distributed ledger technology. We'll talk about mortgages a lot today, but how are those mortgages funded? Well, they're funded through the securitization process. And if you think there's been little innovation in mortgages over the last 30 years, there's been almost none in residential mortgage-backed securities since I first joined in 1989. There's been precious little innovation. It's timely that there is innovation in securitization itself. So we are using distributed ledger technology, aka the blockchain, to bring true innovation to the financing process by having greater transparency, greater accountability, so the investors are much better informed about what they're buying. We've all seen the movie The Big Short, where people just really didn't know what they were buying, and indeed the most hilarious part was where the analyst from Standard & Poor's was vision impaired, which I thought was quite a humorous piece. That's the way it has been in RMBS for decades now. There's been a lack of accountability, a lack of transparency. We're using DLT, the blockchain, to change that so we can finance the mortgages more efficiently and therefore for the benefits of brokers and consumers.
So it's a interactive piece with investors.
Yep.
Is that principally correct?
So they can actually,
therefore,
rather than relying on archaic spreadsheets to actually know what's lying behind the security, they'll be able to use distributed ledger technology and something that we've produced ourselves, we've built ourselves, so they can actually peer into the securities that they own in real time at a granular level, in fact, down to the loan level. So there's no opacity, there's complete transparency, which will actually encourage not only the prices of the securities to improve, but also we were hoping to access greater pools of funds because it's more transparent.
Yeah, okay. So from a a borrower and I guess broker perspective as well in the future. Does this then also play in the open banking space as far as information swap, or is it separate?
Yeah, that's
so you got a back end piece. Is there a front end piece?
Yeah. Sometimes when we're presenting, we're always on the hunt for capital as an early stage company, and sometimes when we're presenting to investors, they sometimes think that we're a SaaS provider or something, that we're a software we're licensing our software. No, we're an end-to-end. We're a lender. We're pure and simple. We're a lender, but we just have some pretty interesting gadgets, if you know what I mean.
Yeah.
And so just the innovation that's possible for many neo lenders and neo banks employing technology in a holistic sense now is just amazing. You're going to see an absolute tidal wave of innovation disruption coming over the next year or two. We hope to be in the vanguard of it.
Yeah, nice. Excellent. All right. Before we get into a couple of these hot topics, and I have a heap of questions here that have been sent through, so be ready, Mr. Dalton.
You know what I feel like? You know what my emotion is? I feel like I'm a Christian in the Colosseum, hoping that the lions have turned vegetarian for the day. Anyway, give me your best shot, people.
No, it's right. I think we'll answer most of these in conversation, mate. So I'll only try and pick up on some separately. But before we do that, there is something that you haven't touched on that you are uniquely famous for that I did tag in our headline was around tattoos. Now, there was a point in time that in our history, I thought that I might in my head thought, well, I might be slightly matching Mr. Dalton in tattoos until I got to know you better. So I only have 3 and they're fairly large tattoos. I have 3. Do you know how many you have?
No, countless. Countless is the answer.
Countless?
So I don't call them tattoos. I call them movable expressionist art, actually. Because every one of mine
is movable because as you get older, your skin changes.
Someone said, "What are they going to look like when? What are your tattoos going to look like when you're 70?" I'm going, awesome. But no, it's just a peculiar hobby. Everyone's got a peculiar hobby, and that's mine, unfortunately. But they're all very artistic.
But the one thing, they are very artistic, and nobody asked me why I've seen most of them. I don't know if I've seen all of them, but we'll put that to one side. But the thing that always has impressed me is that every single one, and there's a few, have meaning. This is just not random blotches on a canvas. Sorry to talk about you that way. But they all have meaning some way or another, and whether it may be an international reference or something's happening in social markets.
In my life, or not so good experience in my life, but so please email me if you want any explanations. I won't give them here now.
Dear. No, it's always interesting.
What about you going to touch on motorcycles as well, Pete, or not?
No, we're not going to touch on motorcycles just yet. Mr. Dalton's hinting at a recent acquisition of mine. Well, we will come back to that at another time, and yours as well. There's another piece of snippet for the man.
Very good.
We'll come back to that. But let's talk a little bit around responsible lending. It's your pet.
It's my pet.
And then we'll talk about clawbacks afterwards. So the thing that I have found interesting, and as always, Dalt, you be at liberty to correct me when I'm wrong, because I know you will. That's where our friendship is. But to me, with responsible lending, I've seen so many people sort of say, "Oh, well, that's going to change best interests duty, and we'll have to see how that impact lies." And da da da. Again, well, it's actually not. It's a separate piece of legislation. There may be some flow back, but it's not a direct sort of. It's not going to dynamically change best interest duty. But with what we've seen, and I'll put it on the table straight away, is that when the Westpac case happened last year with ASIC, we actually supported Westpac's view on things, right? And at the end of the day, it played out that favourably. We didn't agree with ASIC's position, as we don't agree with some of ASIC's positions today on the best interest duty, and I'll talk a bit about that later as well. So give me your headline on responsible lending, what that current piece of legislation will or won't do in your mind, and where you see that sits in the marketplace as a piece of, this is what brokers need to understand about responsible lending obligations. RG 209.
As you did say, this is my pet, so just cut me off if I ramble. for too long, but you might remember that I actually assisted you back in 2008 to draft your response to the initial bill. So it's something that's in my DNA and something I'm very passionate about: consumer protection and responsible lending. The two are actually not oxymoronic; they're hand in hand. And I've lots of observations over the past decade or so. Is that number one, the law is the law, and it's there to protect consumers. It's not there to actually make life hard for brokers or lenders. It's actually there. It's called the National Consumer Credit Protection Act. Point number one. Point number two, RG 209 isn't the law. It's actually a guidance. And many people actually blurred the boundaries between the two and have interpreted RG 209 as actually the law itself. No, it's actually people's opinions on what the law actually says. And the Wagyu and Shiraz case.
And this, I was about to say, this is where the Westpac case fell over.
Indeed. So in a former life, I distilled the 1,039 pages, as it was at the time. It's probably more now, into the 6 core principles of the NCCP. I called it the 6 pillars of the NCCP, but I've distilled that down today. Before the NCCP, it requires you to provide a revisor credit that's not unsuitable, that meets a consumer's needs and objectives. You to do that, so it can be repaid without substantial hardship, you need to actually make reasonable inquiry and take reasonable steps to verify. That's actually the law. What's happened, in my view, what's happened over time is there's been accretions to the law as people have actually interpreted it. And you've actually seen just an absolute overkill of those 4 or 5 core principles in how they've been interpreted. And, you know, I've heard anecdotally, I don't know whether it's an urban myth, but it's probably not, you know, that you get down to whether it's a fortnightly or a monthly Netflix subscription, et cetera, and there was a lot of heat and emotion about that. Well, where does the law say that? It never said that. That is unreasonable inquiry and unreasonable steps to verify. And I'm conjecturing now that many lenders got roughed up in the Hayne Royal Commission, and there was an overreaction that flowed through to the whole lending process, actually. My point is that it was never thus. It was the way that people interpreted it as that. So if I could segue onto the consumer credit reforms now, I had to start breathing into a brown paper bag when I got blindsided by it.
Didn't have a bottle in it, did it?
No, probably should have. It was before midday. Not that that's ever stopped me. Yes, it has. Because I saw the headlines in some of the trade press, responsible lending axed, responsible lending laws slashed. I mean, I started hard hyperventilating because here's the last 10 years of my life, and I'd actually fine-tuned a neo lender to be the most responsible digitized lender in the country, and in one fell swoop, you know, it was all washed away. Then I actually started reading, not the rhetoric, but the actual things put out by the Australian government. I am now conjecturing, so that the NCCP is principles-based, not rules-based, but as I've just articulated, it was on the way to being rules-based. That was never the intention. So I think these new credit reforms are a tug on the leash to get them back to the principles-based and to bring some greater clarity and sanity to the entire process, in my opinion. Here's another thing, and this is completely conjectural, and I have it here in front of me with lots of highlighters on it. We've just been through a once-in-a-century pandemic, and many small businesses need support. Many small business people own residential property. It's my call that many of these consumer credit reforms, and I've highlighted in the 4 or 5 pages that put out by Treasury and the government, how many times small businesses mentioned via the homeowner. Small business is mentioned more often than the homeowner. So here's I'm joining the dots and reading the tea leaves. These responsible lending reforms, and there's a long way to go to March, by the way, who knows where.
And so you're talking about what Josh Frydenberg announced, what was it, a week ago or so,
Responsible lending hasn't been axed or slashed. Ladies and gentlemen, we shouldn't be doing victory laps thinking that low docs and no docs are back. I don't think that's going to happen. It was never a good idea in the first place, didn't end well. It's called the GFC. My conjecture is that many of these responsible lending reforms are there to make it better or easier for small business people to use the equity in their homes to obtain credit. That's my belief.
And the small business ombudsman, and I got to think, because the last 10 months have been rather different as we've all transitioned into COVID issues. So I can't remember if it was earlier this year or late last year, but the small business ombudsman actually highlighted a point in a release that she put out in regards to home ownership being used by a very, very high percentage of small business people to access debt to grow and to fund their business undertaking initiatives.
Yep. Interesting. And getting into controversy corner here, I think the consumer credit reforms are laudable, and it will improve the flow of credit to small business people and to homeowners. But the slight anomaly is that unless we change or have a look at the terms of reference of AFCA, that could be a blocking thing.
Yes, I agree there, and we're fortunate we're in very close dialogue with AFCA, and actually, in fact, I've been asked to do a presentation to their team that oversees credit in early November, mid-November. So I'm doing a presentation to the people who are directly involved with our industry sector to give further guidance on how we operate and so on, because we've sort of got to try and bring balance to a lot of that. And in the small business sector, and we can see from the Federal Treasurer's announcement the other week on the responsible lending obligations and how the budget has panned out. And I'm no economist, but there is a huge emphasis on small businesses there, and trying to, and I hate the way they talk about it. It's all about jobs, and every other word, it's all about jobs. Well, unfortunately, it is all about jobs, but the only way you get a job is to help small business out. So if small business can't function, they are the primary employer in our country. Therefore, there's mass unemployment. So it's a part of re-kicking that economies of the country by helping small businesses out, and then the government doing its bit federally, and then the state government's doing their bit federally as well. And we won't go into state politics. There's a lot of conjecture at the moment, but
you are a Queensland after all.
Look, we're doing all right up here. It's okay. We're not complaining. Everybody else is complaining, so they want to come up here. But at the end of the day, I think we've also got to take a step back with all those conversations politically. No one's done this before. There's not one person alive who's done this gig. So everything's a bit about feeling your way as you go as well. And there've been some real mistakes happen, and probably there's a lot of conjecture that people may or may not agree with decisions, but unfortunately, people are, in my mind, trying to do their best, and unfortunately, sometimes the best hasn't worked out so well, or they've got bad guidance or whatever. But I think we just need to remember that simple little piece. None of us have been here before, so it's all trial and error, unfortunately, and sometimes the errors are quite concerning. But anyhow.
So anyway, so my takeaway message on responsible lending is that it hasn't been axed or slashed or done away with at all. We've got some quite laudable proposals to actually improve the flow of credit and to bring some clarity to the law, but it doesn't mean, because it's a thing about banking. The Medici's kind of invented it in the 16th century, is that you borrow money and you lend it at more than you borrow at, but you've got to actually get it back. So this is not a license just to write poor loans, by whether it be asset lends or just by exercising willful blindness and just making loans that will cause substantial hardship. Hey guys, people, the fundamentals of credit remain. We're just taking away some of the
heartache on the way through. Yeah, and there's not a lender in the country, and probably not a lender in the world, that lends money without the expectation of getting back at some stage. And it's just kind of a given. It's the mechanism which we're. What are your thoughts now? Assuming everything that's been talked about with these changes of responsible lending has got to get through the House and the Senate. It's got to go through its parliamentary processes. You mentioned earlier it's going to be tagged to try and be done by March. Assuming it all goes through, what do you think if the banks will? Do you think the banks will actually take up the reform as they go through? Because in essence, the law will create this is the bottom line, but they may still choose to operate above the line. Do you think banks will do that, or do you think competitive tension will make them come back here somewhere?
What a world in which we live. I mean, credit is the lifeblood of any economy, but what I'm finding over the past few years is well-intentionally, there's so many laws and regulations that are actually impacting the operation of a free market. So to your point, we've also got the Banking Code of Conduct now, which is a whole another layer. So I don't think we're going to see a lending boom because of the so-called relaxation of responsible lending.
It's almost coming back to where we were, or closer back to where we were.
I think we're going to see a lessening of the so-called fear reaction post-Royal Commission, but getting into controversy corner again, that fear reaction may remain if AFCA's remit remains as it is. I'll just flag that.
Okay. Yeah, so that's interesting. So you see that AFCA piece can be the piece that hinders banks coming back too far because they're concerned of being belted by AFCA as such.
That is my belief.
Yeah.
Not saying that AFCA's, I think external dispute resolution schemes are very necessary and a good part of the financial framework. I think the terms of reference might need some examination, actually.
Yeah. Okay. Well, that's very sound thoughts once again, my friend, from you. Yes. All right. Well, there you go.
There you go.
Let's yes. No, you got me thinking about a whole range of things, Dodds. Thanks for that. I just need some more work. That's all. No, not really. Let's talk about clawbacks now.
First up, can I start? It's such an ugly word, Pete, isn't it? Clawbacks. Yeah, it's just such an ugly word. I mean, it has. I was thinking about it this morning. It's like, clawback has got a connotation of being attacked by a grizzly bear or swept on by a raptor or something. And so I got onto Investopedia this morning. Clawback is classically it's a financial penalty for wrongdoing. And what we call clawbacks in this country via the brokers is not a financial penalty for wrongdoing. So I think clawbacks is an ugly word. It's in the law, but it is a misnomer. So I thought I'd just make that point.
Yeah, no, I think it's a very valid point. And from my understanding, when clawbacks first originated, and sorry, to put it all in context, I think I've been against clawbacks since the first day they were actually put out in this country. And I've forgotten how long ago that was, but it was before I moved up here. And I remember having a conversation to a journalist standing underneath MLC Tower and talking about this. That must have been around 2007, 2008, somewhere around that era. And I was against it then from the point of view that if you have done nothing wrong, you have actually done your job successfully. Now, if a life event happens, that's outside of your control. If you breach the law, if you do something wrong, you breach your agreement, commit fraud, whatever it is, you own it. Right, and you're going to own it hard. That's consequence. That's
kind of a financial penalty. There you go.
Correct, the financial penalty. Yep. But otherwise, in my head, and I'm just expressing my thoughts, and we'll dive further into this. But as far as I'm concerned, to me, from back in those days, what brokers get paid is a cost of acquisition. It's like a branch network. The branch is a distribution of product, and they have costs to acquire that product. Always the case. Banks have franchise networks these days. Same thing, cost of distribution, brokers cost of distribution. And so that's just, to me, in my head, that's the principle of it. That's how much it costs you. If financially that doesn't work in your business model, you might have to reassess that. But principally, that's it in a box. I don't see it as anything else. And then the whole clawback piece just grinds to a halt. You say, well, you've acquired the business. So and I'm pushing that back to the lender, saying you now basically own that risk. Unless I've done something wrong, then there's a pushback on that risk to me. Because even back in day one, when the commission structures for brokers were brought into life, if I can put it that way, it wound up getting split to this upfront and trail to in part to assist lenders not to push rates up high, because that cost in that first 12 months would be enormous. And it sort of spread it out over time. So it was a balance between things. Stopping churn was another. And to me, churn, in my mind, was always about portfolio movement, not the one transaction. So when we talk about best interest duty and acting responsibly, in my head, it was never about the one transaction, because the one transaction is all about doing the right thing by the client, if I can put it in that term. But if you pick up a portfolio and move it, you're doing it just to churn and make money. You're not doing it in the interest of the client necessarily. So I always sort of go, well, to me, that's problematic. And I hate the whole concept of it. And as you say, it is an ugly word. but there is a piece of it that needs to be, in my mind, and a piece of it should go. And it's a really hard conversation to have in, this is a you and me conversation now. It's not an AMM position on anything, because
Absolutely.
we've got to watch the ACCC and competition law, and we don't want to be fixing markets. Suggesting this is just viewpoints of two individuals.
Sure.
But you know, that whole piece to me just doesn't make sense, because the banks have then taken all these clients that they've acquired and flogged them a whole host of other products, not just what the broker does. So
yeah. So your views are very well known, and you know you've been out there and proud. And I was doing a lot of research yesterday. One thing I did notice, I won't name which title it was, but one of the industry titles had a piece recently on the clawback regime, and there was 4 pages of comments from brokers, most of which were quite emotive, many of which were derogatory to lenders particularly. And I thought, well, this is there's a lot of emotion around this subject. And I was doing a lot of thought last night, and the discussion around clawback is one of those odd things, is that everyone's a little bit right.
Oh, yeah. Yeah.
It isn't such a black and white, you know, perfectly defensible thing. It's a multi-hued shade grey. All I can do, I'm not here to defend my company's position, industry position, lenders' positions. All I can do is articulate the way we see the facts around clawbacks, if you ask me to.
Yes, I did.
You did.
Very good. I got an interesting question that came, or comment. It said we should be lobbying government to have the to allow brokers or lenders to send an invoice to the client if a drawback's cleared. That'd be interesting. Now, this is an emotional point about charging it back to the borrower if you get a clawback. Now, post the recommendations from the Royal Commission, Home Royal Commission, that is being outlawed, or has been outlawed. So you can't, it's not quite there, but you can't do that. And there's a lot of conjecture about, with people who get, again, in the emotive state about, I should be allowed to, I shouldn't. Now, I can go back a period in time where it was quite commonplace that happened, but of more recent times, it's actually almost gone already. Very few people do it. And I think because, one, it'd be almost impossible to get it anyhow, regardless of what's been signed. If you go to court or a small claims tribunal, they're going to kick it out. But the bad press that you get from it, it just doesn't play out. Yet you've still got to deal with the heartache that I did my job. And something, you know, it's a real quandary, because the good old days before Labor government back in 2008 era, I think it was, I might be wrong on that, banned exit fees. And that sent everything to hell. Because once they banned the exit fees, you couldn't charge, the lender couldn't charge it back to the borrower, which used to happen if things paid out early.
The famous or the infamous deferred establishment fees, as you may recall.
That's the one. Yeah.
I'll pose a question to you. I mean, as I said, I did a fair bit of research over the last 24 hours.
That's not fair. I'm questioning you. You're not fair.
What problem was the government trying to fix? That was exercising my brain yesterday. Because I'm a free market libertarian, and I think the ability to pass the clawback back to the client is part of the operation of a free market. I'm scratching my head as to why that was banned, actually, but anyway.
Yeah, you're probably right. It probably is a part of the operation of a free market. I think that certain consumer bodies have had a big influence on that, saying that it's a bad outcome for borrowers and it shouldn't be allowed, and sometimes the amounts are hard and they're already in hardship as it is, and whatever the conversations are. But I still circle that around and saying, well, you know, in my head, brokers shouldn't be put in that position anyhow, because it's a cost of acquisition to the lender, so it shouldn't be a pushback to start with. And if business models don't support it, and my understanding is there's not a huge percentage of loans that that do terminate early and trigger a clawback. But when you take the mass numbers of brokers in Australia, it looks like a big number, but for each individual broker, it may be quite less. And that's variable from, you know, brokerage to brokerage and state to state, obviously. But I just think it's fundamentally wrong that that should happen, because you got paid to do a job. A bit like saying to Mr. Dalton, you're getting paid to do a job, and whatever happened in the next 6 months, somebody wasn't happy with that piece of work you did and said, well, we're going to take your salary off you. Yeah, it's the same argument to the banks. If a loan discharges early, it's originated through the bank branch structure. They don't take people's salary back off them. Same with politicians. If people don't like their policies or their public statement, they don't then go back and take their salary off them. They wouldn't earn a cent. They might be in debit. No, only joking. You shouldn't say that about our dear friends. But you know what I mean? It's sort of, yeah. It's just you say, well, in all fairness, in all commercial reality, these are small business people who have done their job. Now, if you do something wrong, is different. But if you've done nothing wrong, then surely this does not make commercial sense from the world of a small business point of view. It's a challenging debate.
Should I reply? Should I try and defend clawbacks?
Mate, you look. You can. I think there is a position of defence. There is a defence position that says, from a lender, I've had a cost, and now you're going to make me make a loss. That's not fair. Now, this is where banning the exit fees or deferred establishment fees sort of thing is problematic. If that hadn't happened, a lot of this argument doesn't exist.
Now we're getting somewhere. So some would say that clawbacks are indefensible. I'm about to attempt it. I hope no one throws no one throws a virtual shoe at me. Is that and it gets back to the interference with the operation of the free market. So if I could attempt to do this in logical sequence, in classical economic theory or market theory, there's no such thing as a free option. That's oxymoronic. Every option has a cost. In the mortgage world, we have the equity of redemption. A mortgagor has the right to repay their loan, interest in principal, and get their property back. So that's an option, the option to prepay. That option comes with a cost. Someone's going to pay that cost. In the operation of a free market, in my view, that cost can either be borne by the borrower, as it is. You know a lot about the United States. You've been there a lot. In the United States, you pay points up front, whereas we don't here. So the borrower essentially pays for the cost of distribution there by paying points up front. In other jurisdictions, of course, there's exit fees. And that recompenses the borrower pays the cost of exercising the equity of redemption, discharging the loan. In our market, both of those things have been toyed with. So the free market is the operation of free market has been legislated away, in my opinion. So I can only speak for my company. I'm not spooking my company. I just got the maths of my company in my head. That's all. The maths are, on average, we expect it at the current levels of compensation that we pay to brokers. The maths are that our expectation is the loan will last on average for 4 years, 63.9, but 4 for mathematical simplicity. On average, if many of those loans don't last 4 years, I've made a very bad economic decision. And if I keep making very bad economic decisions, I won't not only get an inadequate return of capital for my shareholders, over time I won't make any profits, and therefore I'll go broke. Which is not good for the industry if lenders start going broke because they've made poor economic decisions, because loans, the level of broker compensation is maintained on a certain mathematical expectation of average life of mortgage, and those average lives are shortened artificially or otherwise. It's not good for the industry because the borrower is now legislatively constrained for actually for recompensing the lender for an early termination. Either two people are going to take it. It's either the lender or the broker. So we have decided, many lenders have decided, well, it's now a legislative 2-year max, that some of that cost of distribution shall be recompensed, shall be received from the broker. That's the mathematical, not emotional equation.
Yeah, and I think that's an important piece too. You got to take the emotion out of it, and you got to think through the economic and business reality of what's transpiring through that decision. Do you think there's any consideration that, again, legislation creates a framework to say, in this instance, it can't go past here, but do you think lenders will possibly bring that back? I mean, we tried to lobby government to make it, well, initially to bugger it off altogether.
I reread it this morning.
I've got to shoot high, you know that. But then to say, well, if not, then shorten 24 months down to 12 months, and say, well, maybe it's 100% for 12 months, and then nothing after that. Now, there is a variation of that in some of the mainstream banking structures, whereby where their external franchise operations after 12 months have no clawback. So not talking in your situation, but in the situation of mainstream banking, there is an ability to do that, but I doubt there is a willingness to do that. That would be in my head. That would there be a commercial viability, do you think, to say, well, yeah, we say it maxes out at 2 years, but that actually could be less? And I'm not saying we should, but I just
a more linear approach, perhaps. A more linear approach would be, it's not signaling anything here, but a more linear approach over 2 years could be equitable. One thing that's really exercising my mind, and I don't have the answer, but it's just exercising my mind, is the dichotomy between a 2-year clawback regime and these cashback offers. I'm still thinking about what that all means. There's some dissonance there somewhere, isn't there? You know, it's
there is. I mean, if they can afford to pay a cash incentive, which basically it is to the borrower, therefore, if you're paying $4,000 out and the clawback's 2, why dump the cash incentive, which I would have thought had issues from an ASIC or ACCC consideration.
That's my view.
And dump the clawback at the back end. You actually become better off. You're $1,300 a deal, basically better off, and actually probably more than that, because not every loan has a clawback. Not every loan terminates early. Whereas you pay this cash incentive up front, so you've actually created a worse position from a lending perspective financially, because you've already thrown that money out.
I'm still thinking the risk through, because it is anomalous, and I'm still thinking about what it means in a macro sense. It just doesn't sit very well with me. I'd have to say that. Can I just get another thing? And we're a wholly broker company. We love brokers. We love mortgage managers. But I'm just getting to thinking that if brokers have their CRM set to stun, and 2 years and 1 day. The CRMs are dialed to phone the borrower for a health check, such that the average lives of mortgages are being shortened by action. That probably wouldn't be good for the industry in total.
No.
I don't think.
No, and
I hope
this
that's
is
not
where
an emerging phenomenon, actually.
No, I agree, and this is where once we get to a point being able to take data from history, which we don't have today, and analyze the trend of what's happening under a best interest duty to see how that is impacting that particular style of activity or scenario. Because the question still becomes what happens if there is an appropriate position under a best interest duty to move the client around at month 13. Because interest rates have dropped another 1%, or the circumstances, life changes, this lender can't help, so it needs to move. So acting in the best interests of a client will trigger a clawback. The debate becomes, will that hinder a broker from acting in the best interests of the client? And there's only one answer to that, and the answer has to be no, because we have touted the professional of this industry to government and regulators all back from 2015, when it was first touted by Kelly O'Dwyer, there's going to be a broker remuneration review, which was done in 2016. The professionalism in this industry, and we are not influenced by those sort of things. And if we breach that, I can tell you now, the review in 2022 will create a significant amount of heartache for every broker in this country if we're not careful.
That was my point. You just said it better.
No, but these things we've got to be cautious of, because it is such a, and this comes back to what it is such an emotive discussion. We've got to put a hat of logic and clear thinking without being clouded by that to understand the consequence of certain actions. And colloquially, we might say at times it's better to shut up and put up. But
hey, there's another phenomenon that's overlaying all of this, Pete, is that you know, we all remember the good old days when official cash rates were tumbling, and remember that you and I have both been in the industry a long time. Remember when they used to have live crosses to the RBA every second Tuesday of the month, just to see what the OCR did, and then there was this unseemly rush to be the first lender to announce what they're going to do with those variable rates. You know, those days are gone. We are actually in uncharted territory here. We have a sustainably low interest rate regime. How long is sustainably? Rates are going to be very, very low, if not lower, for at least 5 years. So those sorts of, you know, and that sort of dovetails into best interest duty and health checks for mortgages, and because variable rates, unless in the absence of lender chicanery, bait and trappery or whatever that is, that rates are going to be, variable rates are going to be very, very stable for a long time. So
now this is interesting, because if that stability plays out as you're suggesting, there's not much south you can go.
There's not.
I would, yeah. So if that is the case, that is what you're saying, that stability be there. So to be acting in the best interests of a client is probably not going to be, as ASIC tends to want to put out, rate driven.
That was my point, actually.
Yeah, there'll be other things that drives things, if they drive it at all, which will be an interesting play in the marketplace.
So hand on heart, I hope broker behaviour doesn't modify to refinancing people every 2 years. So what I'm hypothesising is, I don't know the answer because we're in uncharted territory, but if the best interest of the consumer was served by a refi in 2 years and 1 month, what's changed? Do they want a fixed rate? I suppose is one of the answers, but it's an interesting thought process. I think in both sides of the ledger, both on the mortgage side and on the funding side, the impact of the longevity of low and stable rates hasn't really been thought through all that well.
No, and again, a part of that uncharted territory issue. So I can still remember writing home loans at 21.5%.
I had one, unfortunately.
Oh, sorry about that.
It was dreadful.
It was.
We had a bank. Can I say this? Yes, I can. We had a bank not recently. It was actually early last year. Who was aware of the fact that rates are low and sustainable, and actually said, "Can we perhaps fund you into a 30-year fixed rate?" And I was taken, because I'm used to hanging around in the USA. I was just aghast. I mean, you can't hedge that. We're not going to hedge it. We're actually going to. We think that rates are going to be so low sustainably. We'll partially hedge it, but we think there's a chance for a 30-year fixed rate. That was an interesting debate. We ultimately didn't take it up, but it was interesting consideration. That's the sort of thing you need to think about.
Yeah, and that's commonplace in the US.
Oh, very much so, but that's the government. That's interesting. Who takes the risk there? The poor taxpayer.
That's right. Yeah, so that's something that most people don't understand. It's the taxpayer in the US that bears the risk of that.
Of course, Fannie and Freddie and the other GSEs.
Because as you said earlier, somebody pays.
There's no such thing as a free option. So someone pays, and unfortunately in the clawback.
I've got a couple of things here that come through, and this is partly a question I had earlier, but also another one's just come through. It talks about, if clawback stays, should there be a review, and give a reason why it shouldn't happen. And I think we've spoken around the whole issue of the wheres and wherefores as clawbacks are, but I can say that the FBAA is doing a review on this. It's something that's very difficult as industry, as a collective, to do, because there's a whole host of competition law issues that sit in there. But based on a conversation I had in Parliament House, Canberra, back early December, and a response to something I was doing at the time without sort of positioning too closely, has actually spurred us on to do a research piece around this, and that will play back to some of the objections that were being expressed at the time. And it's we're just never going to get rid of it. That commercially isn't going to happen. There is a place for clawbacks. I'm just very much against, I've done nothing wrong, I did my job, and now you're taking my money off. You're not going to reimburse me my expenses, because I paid for salaries, rent, telephone, cars, fuel. I had to pay that expense as a cost of my business, yet you've taken all that money and more away from me, and I'm now worse off. I'm really, might as well just pack up and go home, sort of thing. So, I just say, well, that isn't fair, doesn't make sense. I come back to, and I'm sounding probably too repetitive, but cost of acquisition.
I know you're passionate.
But at the same token, at the same token, there's a balance of economies that sits on the lender's end, but I own this cost. I almost think what we need to do is to unwind Labor's decision of banning exit fees and allow that be passed back as an exit cost to a borrower if they discharge their loan early.
I think I'm conscious of the fact there's 109 people watching this right now, and I don't quite know who they are, but this smacks the whole, as I referred to before, there's this overlapping and interwoven series of regulation and legislation. It smacks to me as if it was much of it was done on the fly without a sufficient consideration of the anomalies between each bit. And I think it's hard, but the legislation it's still wet. It's not even dry yet. But I think it's timely that it be reviewed to see the unintended consequences, actually.
Yeah. I have one comment here from somebody talking about, well, why don't, there's no upfront and trail and simply a commission paid on the loan as it's being paid. So like the whole thing being dripped out, which I guess is a consideration for thoughts. My problem is then you've got a business to run, and you know the balance in the upfront and trail is to help support the business so it can economically pay its way as well. And continue to service the client on the way through. I think that'd be fairly challenging.
Do you remember the time when there was no upfronts? I do.
Yeah, I remember it was all fee for service, but that's changed too, because now so much time has passed. Borrowers don't expect to pay for it. Now, there was a research piece done by Momentum Intelligence about 1.5 years ago around this, and it came out that basically even at $2,000, borrowers won't pay because we have now conditioned them not to pay. So every generation that comes through. Hey, you know what the interesting thing is, in the US, they add 10 basis points to do an online home loan. So it costs you more to do it online without a person,
you know what,
but it does face to face. Yeah, 10 basis points.
What's the rationale for that?
I have not, well, premium service.
Oh, I see.
Well, I don't, yeah, I struggle with a bit here. Sorry, side issue.
Side issue.
But yeah, I find it a funny anomaly. You do it online and do it quick, and you get charged more in your rate. 10 basis points.
Clawbacks is something we talked about before, and is that, you know, why aren't clawbacks over a 2-year period? Why aren't they more linear? Why do they have this cliff sort of thing? You know.
Yeah.
And no disrespect to any incumbent lender, I suspect some of it is because it's a big legacy systems challenge. I suspect
it could well be, and to me that's not an excuse. They should be bringing their technologies up to date, but it is possibly that. But didn't we start off though with a more linear, but an annual structure down? So like in the first year it was 100%, second year was 75, then 50, 25, then nil at the fourth, something like that in securitization.
In the AMS days, we certainly do
Yeah,
that.
and that was not an uncommon sort of step. And you sort of go, okay, well, that probably has more sense to it. I still don't really like it personally, but it has more logic to it in a degree. I much prefer the good old days where it was passed back.
Okay.
Sorry?
I do. I have some sympathy with that view.
Yeah. I've got a couple of points, a couple of things here around best interest duty, and an interesting one here says, with the obligation of responsible lending and the best interest duty going forward, why do we face lenders' barriers of targets or priority broker group statuses? Now, I'm very
This is not my wheelhouse. I'm not qualified to answer.
That's all right. Well, I'll talk a little bit on it, and you can just look handsome as ever. But I'm against broker groups. I was when the commission review was done. They only got held on by the skin of their teeth because it was going to be qualitative based, not volume based. My understanding that the quantitative position, so the volume is still there, and I think that's disgraceful and needs to go. Personally, I think all broker groups should go anyhow, because you know it's got nothing to do with the broker. There's an innocent customer sitting there who's waiting to get a loan approved. So why are we penalising the innocent customer? I find that quite challenging. And the other piece here on best interest duty that came through is around bundled products, and in particular where credit cards are packaged into a bundled product. Now, this is an area which I mentioned earlier on, but before we started the show, and we've written multiple submissions to ASIC on it, and I actually just finished another one yesterday to ASIC that had this included as well, is that ASIC, and this plays back to your comment before, Dolz, ASIC's Road Tree Guide 273 goes beyond the intent of government and the law through the explanatory memorandum of the Act that was passed and put through. It goes beyond that. And therefore, the impact is that under the law it was written, and we've documented this again to ASIC, and as I sent it off again yesterday, but this is probably the third, if not fourth time we've tackled this, is that the best interest duty has to be applied to every product within a bundle. In the law, we had it agreed, and it was written, it's in the Act, is that the best interest duty, in my colloquial terms, is applied to the predominant debt. So we will take that 99.99% of the time, that'll be the home loan, unless somebody takes out a $50,000 credit card and a $10,000 home loan, God knows why they do it. Then that swings it the other way. I said that, but in the way the Act's written, it's fine. in the way it's in the regulatory guide, somebody's interpretation, and have taken it, this isn't law as such, the law is back here in the Act and the EM, you've got to apply best interest duty to a credit card in a bundled product. Yet there is no transparency to credit cards at all, from lenders back through to aggregators, so it can be fed back to the borrowers, brokers, right? And then the brokers act in the best interest of the client. So you're being expected to apply a duty to something you can't see. Now, again, this is the third time. One was verbal and two in writing to ASIC again yesterday, saying, well, if you are not going to change this, then you need to be directing lenders that they must be giving the details of the data through to the aggregator on all credit cards, whether they're bundled or not, because it's consumer debt, back through to the aggregators so they can disseminate that to the broker so that they can give their recommendation, their position in a best interest duty on that particular thing, on that particular item on that credit card. Because today you can't, which means that every broker who from 1 January next year organises a loan for a borrower that has a credit card in it, without that transparency, they have just breached the best interest duty, maximum penalty just over $1 million. And that's just disgraceful. That's taken the law out to.
Well, sorry, I'm leading with machine here. It's not disgraceful. It's nuts.
Yeah.
It's nuts.
Wow. Absolutely.
The credit card interest rates can change at a whim. How do you do a best interest duty on that? Weird.
I know, it's crazy.
Weird.
Interestingly, somebody's just come through and said both one of our major aggregators and a major digital bank have announced linear clawback arrangements. So it seems like the logic is starting to flow through, and I see that as a good first step. I'm not suggesting it's the last step, but I do see it as a good first step.
I have some sympathy with your view. I do. It's diplomatic.
Diplomatic, that's right. There's another comment just come through. It says, when trails pause on an overdue account, which is fair enough, the trail stops. Why is it then not, isn't there a catch-up plan for trail when the client comes back into arrears, comes back into order? So you stop it for here, but as it comes back into order and they start pile trailing again, you just completely lost that.
90 days, for instance, and that 90 days just operates, doesn't it? Interesting question.
I don't know if, because I guess there's been arrears collected through that period of time, right?
Hopefully.
So the lender's actually made more money, and you may not want to have this debate, that's okay, but the lender's made more money, but they pocket the extra surplus as well as the normal amount. And when it comes back to order, they just start at the lower benchmark or the original benchmark for the broker. So the bank, the lender has taken all that. It's an interesting thing to ponder.
It is interesting, right? Particularly if I think higher rates are so last century. I don't think too many people are levy the default anymore.
Yeah. Mr. Dalton, we've actually run out of time, and I've got more questions and things coming through.
Went quickly.
It went very quickly. So just for people who've been listening, if there's questions here, I think a lot of them we have covered in our conversation, but I will pick up on these, and the wonderful Mariah, who's sitting out the back behind us all, monitoring and managing everything for us, she'll move those questions into my next segment. We'll catch up on those. But Dalton, I wanted to say thank you so much. I love our conversations. I have for years and years, and probably decades now, it goes back that far. Always love our conversations, and they're always mentally stimulating, challenging is the way they should be, and full of wondrous insight and vision of things. And I think everybody, regardless, try and take the emotion out of some of this and think it through. We'll never get rid of the emotion completely, I understand that, but take the essence of the conversation and understand that I know from the FBAA we are fighting hard on clawbacks, always have been and always will, but there's a balance as to where this lies, and lenders such as Kym and with his knowledge and the way he's going about doing things, we can see that these are laying up the future and the stability of structure as we go forward, and I think that's a very important thing. And let me know when you get your next tattoo, mate, and we'll do a piece on that. We'll do a show and tell.
Thanks for having me, everybody.
Okay, thanks, Kym. All the best.
See you.
Take care.
Bye-bye.
See you, mate. All righty, Mr. Kym Dalton, what a wonderful man. And I always love, as I said, the conversations that I have with him. And I know there'll be things that we don't, everybody doesn't agree with it. And it's not about agreeing with everything. It's about just being able to sit down and have a reasonable and fair conversation and try and work these things out. As you all know, I am against clawbacks, but there is another side of that conversation. Unfortunately, political manoeuvres in the past have hindered where all that stands. Challenges in the current marketplace bring challenges of their own in regards to this conversation, but that doesn't mean we don't stop fighting. We're continuing with our research piece on this, and I hope our initiatives and our aim is before we get by the middle of next year and before the review of 2022 from the Council of Financial Regulators and ASIC, so before they start that, which I expect it'll be around June next year, maybe earlier, that we will have these pieces to be able to table then, and also to government to mitigate what I believe where their arguments are around this conversation. Doesn't mean they're going to listen, but we're damn well keep fighting and give it our best, I can assure you. Anyhow, thanks very much for joining us. Next week, get ready for next fortnight, I should say. There's an old habit. We're having a conversation in 2 weeks' time with mortgage managers within our industry. So these are the people that play in the securitization space and or are just outside of mainstream lending. From when I say that, they're not a major bank, they're not a second tier bank, they are a mortgage manager in their own right. We're going to drill in to see how they operate, how they're finding things, and how they will advantage you, as opposed to neobanks and new lenders such as Kym Dalton is doing with AMM. So get ready to register for that. That's Thursday, the 22nd of October. Thank you so much for being with us. And don't forget, at the end of this, or before we do that, thank you to our sponsors who support us. Love them. They support us in a really wonderful way. So I really appreciate their support. And remember, to a little survey that you get, please give us your feedback. We need it. It's important. It helps guide us as we go forward, especially as we go into 2021. It'll be a new norm that will exist in there. We want to make sure we get it right for you, and also your CPD code will be issued as well. In the meantime, you can always watch this and all the other episodes of Q&A with Whitey and all the other things that we do from a PD day and so on. You can watch it on our YouTube channel. Don't forget to if you want to catch up on anything or review anything, everything's on our YouTube channel. Go there and you'll be able to watch it again. And in the meantime, enjoy the rest of your week. Been great chatting as always, and take care, and we'll see you soon once these borders are down. Take care. Bye for now.